Namaste, welcome to Arthaniti, where we discuss money and money related tools to help you in your everyday investment decisions. I am Dr. Shefalika Gokhale. I hold a PhD in business practices of mutual fund houses. In today's video, we will discuss the small and mid cap sector. Why was there volatility in this sector? Historically, how has been the performance of this sector? What does the future hold for this sector? Is it a good investment option today? And how do you analyze all this to reach a perfectly good investing decision? To begin with, few days back, Madhavi Puri Bhuj, the chairperson of SEBI, had flagged off the small and mid cap space, saying that a froth was getting built up in this space, which would become untenable to keep pace with, and subsequently the share prices or the small and mid cap indexes would see a significant fall. This was followed by a stress test that AMFI had asked all the AMCs, the asset management companies of mutual fund houses, to carry on in their small and mid cap funds. The results of those funds were like I have discussed in my previous video, a link to which I will share on the screen. Now, following this, we saw correction in this space, in the small and mid cap space, where the stock prices of many small and mid cap companies plunged. In this video, let us discuss whether this space is still a viable investment option. How has been the returns historically? One thing is certain: every time there is a correction in the market, it opens up an opportunity for you. You can invest your money in the market at the time of correction at reduced lower prices, and the possibility of gaining higher returns over a period of time as and how the share prices increase is far higher, rather than entering into the market when it is at its peak. But the question remains whether this correction that we saw few days back, was it the ebb, the lowest point from where the short and mid cap companies indexes will go more higher, or is there a further correction that is on the cards and we should be waiting for that correction to happen? Think about it. Every giant corporation, every multinational, multi-billion dollar corporation that we see today started humbly on a very small scale. Take the example of Samsung. Samsung started in the year 1938 with a mere 30,000 wons, which is roughly $28 today, right? The first business that Samsung entered into was a grocery trading company. Today, where is Samsung? It is nearly a $300 billion electronics giant. Nearer home, if we take the example of a company like Reliance Industries, established in 1967 by Dhirubhai Ambani for 15,000 rupees, the company started off trading in textiles. Where is it today? It is a conglomerate. It is a huge conglomerate with valuations of nearly 17 lakh crores. One more example: Infosys started in 1981 in a small apartment in Pune with a share capital of 1 lakh rupees, borrowed mostly from Narayan Murthy's wife. Today, Infosys has pioneered the IT revolution in India with valuations of more than 6 lakh crore. So, all companies that are multi billion companies with exorbitantly high valuations that we see today started off in the small cap space at some point of time. What will help you get those kinds of returns is trying to figure out which company in this sector, in the small and mid cap sector, has the potential of reaching the heights of Samsung's or Infosys or Reliance in a few years' time. That is the catch. That is where you should be able to analyze and invest your money. But if cracking that code would have been so simple, everybody of us would have become Rakesh Junjunwala or Vijay Kedias of investing. Well, it is a difficult task. Many factors go into taking the right decision, and we will discuss some of these factors which will help you understand what is needed to figure out which is the right investment and which investment will give you good returns over next few years. It is very important to look at the historical numbers, though historical records do not guarantee any future returns, but it helps as a guideline to expect what future holds for us. Right? If you compare the numbers of small and mid cap indices with the BSE Sensex in the last 1 year, I'll put up the screenshot of the comparison sheet so that it becomes easier for you to understand. In the last 1 year, BSE Sensex has given a returns of roughly 24%, whereas mid cap and small cap indices have risen nearly 68%. See, the BSE Sensex comprises of large cap companies. So in that comparison, small and mid caps have given roughly more twice or 2.5 times as much returns as the Sensex has given in the last 1 year. If you compare the figures for the last 5 years, in the last 5 years, the Sensex has given a returns of nearly 14%, whereas mid cap has given a return of 21% and small cap has a return of 25%. Over the last 10 years, if you see the figures, Sensex has given a return of 12.70%, whereas mid cap 18.9%, so roughly 19% returns, whereas small cap has given, I'm talking about indices, has risen nearly 20%. Over the last 15 years, if you see, BSE Sensex has given a return of 14.2%, mid cap index has given a return of 18.67, and roughly the same for small cap at 18.61%. So if you compare 5-year returns, 10-year returns, and 15-year returns for Sensex, mid cap index, and small cap index, the rough average, if you see, is for Sensex, it is nearly 12 to 13%. For mid cap, it is roughly around 18%, 18.5%, and small cap is roughly around 21%. Now, these are averages if you compare the returns over the last 15 years. Compare this with the last 1 year returns, where I have already told you that mid cap and small cap index gave a return of nearly 68%. So, where the 15-year average is around 20 for small and mid cap, it has given a return of 68%. Now, for Sensex, which as I told you already comprises of large cap companies, the return is roughly around 13%, where it has given 24%. What do you make of all this data? See, what has happened over the last 15 years, the average returns that we have seen over the last 15 years, the market will tend to give the returns not far away from what it has over this long period of time. So, expect a correction. Again, what this data reveals is, in comparison to large cap sector or space, the mid cap space is highly above the average. Compare 20 21% with roughly 68%. So it is exorbitantly overpriced compared to large cap space. So with all this, what answer do you get in mind? Which sector looks attractive for investing at this point of time? Well, the figures don't lie. The answer that these historical figures give is large cap space looks more attractive valuation wise for investing right now in comparison to the small and mid cap space. um, again, the longer the time duration you have, the higher the risk that you are able to take, and the uh, higher the risk, the more riskier stocks, which obviously lie in the small and mid cap space, is where you can invest your money. Legendary investor Vijay Kedia, who is famous for his rhymes and songs, through which he helps us understand the investing game, has wealth accumulated over 800 crores. His investment philosophy is simple: smile. Well, not actually the smile on our faces, but the smile which he has formulated, the word that he has formulated for small companies with medium experience and large aspirations and extra large potentials. He looks out for companies which fit these criteria and then invests in them. In one of his interviews with CNBC TV 18, he spoke about an investment that he did in a company called Tejas Technologies, and how the stock plummeted from 400 to 40 during COVID, and today has given him 20 times returns. Now, do we have the patience? Don't we hit the panic button if the stock market, if the stock prices would have gone from 400 to 40, seeing our investment wiped out nearly completely? Yes, that is the difference between seasoned investors and investors like us. Now, this philosophy of Vijay Kedia, if we are able to understand what he means, small companies, companies today which have a small capital, which have a small organizational setup with medium experience, 5 to 10 years experience, which have large aspirations, which have an outlook where they want to be the market leaders in the space they are working in, and extra large potential. They have the capacity, they have the expertise, the kind of people, the knowledge, the products that they come out with, all show extra large potentials where the company can achieve or get leadership positions in the space they are working in. Trying to figure out such companies is the key of Vijay Kedia's style of investing. Next, we will discuss the American fund manager Peter Lynch, who is well known for his book One Up on the Wall Street. Well, he propagates a bottom up approach where he says that investments need to be picked up one by one and then thoroughly investigated before taking a decision of putting in your money in them. What he tells you is that there is no set formula of selecting a particular kind of investment, but what people should look out for are good stories which you can relate to based on your experiences in your field of work. Now, good stories means stories about the companies that you wish to invest your money in. Read about it, try to get more and more information about the company that you are looking for prospective investing. Lynch says that always look out for a company's earning plans. How does it propose to increase its earnings? He says there are 5 ways in which a company can propose or plan to increase its earnings. First is by reducing cost. Second, raising prices, expanding to new markets, selling more in the old markets, or revitalizing or closing or selling a losing operation. Now, which of these does the company that you are looking at for investing is adhering to, is what you should be able to find out through all the information that you can get about that company. Lynch stresses on categorizing the companies based on the storyline of those companies. Now, the categories that he has formulated, the first one is slow growers, which is the companies which are large and aging companies and which grow only slightly faster than the national economic averages. The second categorization he says are stalwarts, large companies which have been in businesses for some time and still have a potential to grow. If you invest in these companies, at the right time, it will still give you not above average but good returns. The third categorization are fast growers. These companies may not be large, may not be old, but the stocks have risen significantly high. Like if you follow US stock markets, you must have seen what has happened with the Nvidia stock in the last few days, where it has grown enormously high in the last few sessions, right? Pointing out these companies, he also says there is a higher risk attached to investment in such kinds of stocks, which gives you above expected returns. Then he categorizes the fourth kind as cyclical companies which have a high, have a few years of high, and then the cycle turns down. The catch for investors is to know when the cycle is turning downwards. Few stocks like say auto or airline industries, steel industries work in a cyclical nature. The next type that Lynch categorizes are turnaround companies, which were down, battered, depressed, but which have seen a revival in their business thanks to the strategies that they have adopted and improvements that they have done, taking into considerations the market expectations and changes that happen around the companies. Now these companies, if you invest in them when they were depressed and down, and see a potential in them, as what Vijay Kedia large prospects for these companies, if you invest in them at that time when they were down and depressed, then it would give you great higher returns. Catching them young is one phrase that Lynch uses, so that you know the next Microsoft that you want to invest your money in. Entering the market, entering a particular investment at a fair price is also one of the important factors which has an impact on the kind of return that you see in your investments. While investing in the small and mid cap segment, please do not ignore these factors. What is your risk taking capability? Do you panic easily? Will you lose your good night's sleep if you see your stock prices coming down or your investment wiping off? Some of us experienced this during COVID. What is your time horizon? What investment goals are you looking for when you invest your money? Is your goal specific to be achieved in a specific period of time, or are you investing to create wealth over a long duration of time? Have you diversified your investment? One way to invest in small and mid cap space is through mutual funds, small and mid cap mutual funds, where you can invest in a whole bunch of companies in this sector by investing in one fund. Correct? There are ETFs and there are actively managed funds wherein you can from where you can choose from. Ignoring these factors will only lead to losses. So please pay attention to these factors. Last but not the least, no investment is without risk. If you are looking for good returns, you will have to take some amount of risk. Higher the risk, higher the returns. The historical data that I presented to you do not in any way guarantee future returns. They just show you a path. The best way to choose an investment is to approach your investment advisor and take his advice, and then what suits you, what your mind tells you is right for you, that is the way forward for you. I hope you have liked this video that I thought of making, because there is so much buzz around small and mid cap segment. Please hit the like button and share and subscribe to my channel for more such engaging and informative videos which will help you in taking right investment decisions. Until next time, stay safe.